Thank you very much. Thank you, Brand Innovators. Thanks, everyone, for coming, and happy CES. So just a brief background. Madison Wall is a consultancy, advisory research firm for technology, media, services companies focused on the advertising industry. By background, many of you may know, I used to be a banker and analyst, worked in agencies, 2 tours of duty, also a little stint in ad tech. So what we do every quarter is we publish advertising forecasts. We update historical data and project out as well, and do it on a quarterly basis for quality data. And so the focus of this conversation is really the work that we published at the beginning of December with our updated estimates for 2025. Pretty good way to start off by talking about the year ahead, and I think we'll also be fodder for the conversation that we'll be having with Jeff and Paul and maybe Harry shortly. All right, so the way to think about 2025 now is comparing it to how we were thinking about 2025 a few months earlier. We published our prior forecast in September. Now, at the time, when we were looking ahead to what would have happened in 25, obviously politics would have been a thing, a part of the consideration set, and there are a range of possible outcomes. Let's just say the outcome was probably the worst one you would have wanted for the advertising industry. And again, I try to be apolitical. You'll see my biases come through, but I try to be as apolitical when I'm looking at this as possible. And we'll go through what the various considerations are when we think about the current year. But if you take policies at face value, they're net negative relative to where we otherwise would have been, but still positive as sort of a base level assumption. In other words, we're still expecting growth in the advertising industry this year. But if you take a look, now you have to look really closely. That was kind of what we were expecting, and that's kind of where we are now. It's still growth, but it's the difference between 5.5% growth ex-political and like 4.5% growth. So just keep that in mind. Incrementally negative, but still positive overall. And so as we go through the factors that are going to impact the year for the advertising industry, let's go through these buckets of items to just give some thought about how they will impact the advertising market. And to be clear, we're primarily focusing on sellers of advertising, meaning the media owners, which is just to say that's the flavor of the market. Again, you could argue as marketers, it's actually good if it's weak, to the extent that if sellers are weaker but still very sustainable, you're arguably in a better position for pricing and terms and all that fun stuff. Of course, I think everyone in the room probably still wants a stronger advertising market, right? Especially sellers of advertising. But it's so I try not to be overly qualitative in saying it's positive or negative to say it's strong or weak. Here are the factors that will lead to positive advertising, meaning more growth this year relative to what would have happened. More deregulation. Okay, so when you get categories that are just more liberalized, so think cannabis. If cannabis became a legal thing across the country, you'd have cannabis advertising. It's undoubtedly the case that there will be various categories which will be deregulated in different forms, and there would be more advertising as a consequence. I can't point to any one category right now, but in terms of a general theme. Lower interest rates. Now, if you're Jay Powell, you're probably going to try to keep higher interest rates. But we also know there's going to be all sorts of efforts to undermine Jay Powell, when, not if, he tries to do that. And the consequence will probably be lower interest rates. This is my bet. That's maybe bad for the economy if the economy actually needs higher interest rates, but it's positive for advertising if costs of capital are lower, because it's just cheaper to raise capital to go spend on acquiring customers. Higher inflation. Here's the thing. Inflation is positive for advertising. Again, it might be negative for an economy, but as long as you have underlying growth in an economy and you have inflation, because we're measuring in nominal terms, more inflation means more growth in advertising. So that, you could say, is positive in the sense of a stronger number. Neutral factors. Tax cuts. So this is the thing that's driven a lot of Wall Street's response. Remember, Wall Street is not the economy. Just because there will more likely than not be tax cuts, even if they're not put into place during 2025, it seems very likely that this will happen. But it will have almost no impact whatsoever on advertising. There is no empirical relationship between cuts in taxes and advertising. So just keep that in mind. Again, independent of whether it's a good or a bad thing. Now the TikTok ban, it's hard to say how this plays out. My bet right now is that it probably does go away, but that's like a 52% probability, like, I don't know, we're all just guessing here. But it won't make a difference in terms of the pool of money in the ad market. Now, had I written this slide this morning as of about 4 hours ago, I would have also made note of this, I think, incredibly important news from Meta this morning. If you haven't read it, and those of you who are subscribers to Madison, you'll get my note on this. If you're not, give some thought. The elimination of third-party fact-checking on Meta, and basically a real degradation, the whole concept of brand safety and brand suitability on Meta in particular, and calling out X, now that Meta's going to mirror what X does. The consequences on the ad market, I think, are neutral because for better and worse, I think most people in this room won't change their budget allocations meaningfully. If anything, I think you're all more likely now to spend money on X. I would not have said that 24 hours ago. But it won't make a difference in terms of the overall market. The money won't be changed. Negative factors, okay, restrictions on the pharmaceutical industry. When I wrote the forecast at the beginning of December, at the time, Matt Gaetz was still a candidate for Attorney General. And the, shall we say, audacity of some of the candidates being put forward, including RFK Jr., suggested very strongly that there was going to be an effort to really railroad through a lot of things. And it wasn't much of a leap to say, if RFK Jr. wants to ban pharma advertising, they'll find a way to make it happen. I still think there's going to be some meaningful restrictions, and we'll talk about this on the panel. I think that there can be a counterpoint to this too. But it has to be viewed as incrementally negative if you're probabilistically looking at this, to say that with RFK Jr. likely to be confirmed, I'm assuming that's the case, in HHS, my guess is towards the end of the year, there's some kind of restriction put in place or some kind of change that's negative for advertising. More M&A is probably negative for the ad market. And just to give an example, if Albertsons and Kroger were able to merge, 1 + 1 would have been 1.8, right? Like the reality is that in most categories, you will not see growth in advertising because of consolidation. It's only when you have like a hyper-fragmented industry where there's, say, 100 different companies rolling up into an oligopoly, like 10. You need oligopolies to get growth in advertising. And so, and this is a whole thing we could talk about, but the point is that most of the kinds of M&A that I think will happen that'll be significant will be of the oligopolistic kind, which will towards monopoly, more concentration rather, and that will lead to less advertising. Now again, will any deals actually get announced that will play out like this during the year? It's unlikely they get closed by the end of the year, but it's an incrementally negative consideration for the advertising market, certainly going beyond 2025. Higher tariffs, very negative. And if on day one, meaningful tariffs are put in place, this is very negative for advertising, especially for retail media, especially for anyone dependent on cross-border trade. Because so much of what gets bought through e-commerce in particular is transacted primarily from China, and they're huge spenders on advertising. So this is a meaningfully negative consideration for the ad market and retail media in particular. Deportations as well. Again, if those things happen, meaningfully negative. Not only do you lose consumers, but the supply chain consequences. And again, I'm trying to be as apolitical as possible. There's a human story to this too that we shouldn't ignore. But purely from a business perspective and an advertising perspective, do you remember when packaged goods companies couldn't advertise during the pandemic because they didn't have stuff? If supply chains get meaningfully disrupted, depending on the scale, then that's a negative consideration. Now, I think those latter 2 points are probably the most directly impactful on the advertising market. And your key takeaway from that is uncertainty, because we don't know the degree to which those things will happen. It could be that saner heads and a business sense prevails, but then we have to remember who's going into the White House. It's not, and the circumstances around that election. My bet is that we do get those higher tariffs and we do get meaningful deportations, or at least efforts to make those happen. And those will be meaningful in terms of the consequences on the ad market. But I'm just guessing. Your opinion's as valid as mine on this. We don't really know. Okay, shocker, digital keeps taking share. So really just continuing with the trends that we've seen before. I think I'll leave it at that. Now to our panel, I think.
Thank you, Brian.